Good morning, everybody. How's it going? I am doing a live right now on here on Instagram and on YouTube. Quick question for you guys. This board, can you see the letters? Are they backwards or are they the correct way? I'm on selfie mode, so to me it looks backwards. Let me know if you guys can read that. Because I am going to be writing stuff down, giving you guys visuals. So let me know if it is working. Backwards. Crap. I wonder, people on YouTube, are the words on this backwards or are they the correct way? Let me know, because if they're the correct way, I'm going to be writing things on this to give you guys visuals. And let's see, if they are good, then anyone who is on Instagram that can't read it, and if it's good on YouTube, cool. So everyone's saying that's good. So if you guys want to head over to YouTube, I'm on a YouTube live at the same time. So everyone on Instagram, head to YouTube live. Ask me questions. I'm going to get into tax structure, what I personally do, which is super, super high level on a tax planning, tax strategy standpoint. But then also what you can do if you're not quite at that point, because a lot of people think they have a tax problem, and it's not true. Most people have an income problem. They don't have enough money coming in, and therefore they just need to get their income up. Once your income is to a certain point, there's only so many write-offs you can take. That's when you have a tax problem. So for everyone that's in that place, I've got different strategies and different things that can help you guys. So I'm going to be going over that. I'm going to be going over how to get your money deployed, how to get it working. I'm going to be going over infinite banking, how that works, all kinds of stuff. So if you have questions and you're on the Instagram live, head to the YouTube live that I'm on right now, because everything on this board, you can't see it. It's backwards on Instagram. It's not backward on YouTube. So head to YouTube and let's get things going. So let's see. We got Life 180. So if you guys are not following Life 180, that's Chris Kirkpatrick, the real Chris Kirkpatrick. He's the homie. We actually met in Indiana last month, and just instant friends. He's in the space of infinite banking, a wealth of knowledge. He's in real estate, so I would highly recommend you guys follow him, because you can learn a ton. Let's see. We got Michelle on here. What's up, Michelle? Let's see. We got Frank Meza. All right. So true. He said just flip the Instagram camera around. So everyone on Instagram, I'm not going to be answering your questions on here, but hopefully you can at least see my screen and see the writing on my whiteboard. All right. All right, guys. So first and foremost, I'm going to go into really how I protect my capital. Because at the end of the day, first thing you need to learn how to do is to keep more of the money that you make. So think about this. When you make money, actually, let's go to the board. All right. So all right. So think about this, guys. When you make money, most people, what they do is they earn money, right? So they've got a W-2 job. And when you earn money, that's the biggest taxed money. So before you ever see any of your money, you lose money to taxes, right? So depending on how much you make, depends on how much they take. The more you make, the more they take. So as you start earning more money, the government starts taking a higher percentage of that money. So you're losing it to the federal government, first and foremost. Okay. Once the federal government takes those taxes, what do most people do? They take the money and they put it into a 401k. So a 401k is you giving up control of your money. Now you don't have control of it until you're 59 and a half. So you've given up that control so that this is what most people do. They give up control because with the 401k, you avoid taxes, right? You're not paying the taxes. That's what most people think is a big benefit. It's actually not a benefit because taxes don't go down, they go up. Historically speaking, taxes do not go down. So you're avoiding taxes now when you know what they are to pay them in my example, I'm 37. So I would pay them in 22 years. Who knows what they're going to be in 22 years? They're probably going to be higher. So you're avoiding paying taxes now to pay them later when they're probably going to be higher. Makes no sense. You're giving up control of the money now while it's worth the most. See, inflation devalues the dollar. So the money's going to be worth less in 22 years. In 22 days, it's going to be worth less. So that's what most people do. They put their money into a 401k. Then they pay their bills, right? They pay for their car payment. They pay for their house payment. They pay for their credit cards. They pay all these other people, and then they're left with a small amount of money. So after you pay the 401k, you pay all your bills, and then you are left with your savings. So the savings rate in America is about 5%. So out of every dollar you make, you're only saving on average a nickel. Crazy. Most people are going to tell you to become wealthy, to become rich, take your savings, the nickel, and go make a bigger return. If you do that, though, you're raising your risk. Your risk goes up when you go chase a bigger return. So you could lose everything because you're having a higher risk. What I want you guys to do, I don't want you to take on any more risk. I want you to simply control where your money goes. Because if you can simply control who gets the interest on your bills, if you can control your money instead of it going into a 401k and giving up control, you have control, meaning you keep all that money. You keep what you're giving away to other people. Now, the biggest eroder of wealth, there is interest to other people. So that's your bills. That's a huge eroder of wealth over time. There is taxes. That is the biggest eroder of wealth, is taxes. So how do we lower our tax bill legally, right? There's a lot of different ways. Now, there's a lot of different write-offs and things like that. But as a W-2 employee, there's only so many write-offs you can take, okay? So basically what you need to do, you need to start a business. That's what it comes down to. And a business doesn't need to be a storefront. It doesn't need to be this or that. A business is simply an entity that you run things through. So you guys got to be able to start an LLC. So that is a limited liability corporation. So what that does is when you can start a business, you now can flow things through the business. You have more write-offs that you can take. So you can start a business for anything. It could be a side hustle. It could be whatever you want. And now you have a corporate structure that you can run things through to minimize your tax bill. Now, There's tons of different ways to do this. What I would recommend, guys, is you speak with someone that is extremely knowledgeable about this, someone that's their expertise. Okay. So I have a company that I can link you guys up with. It is basically a company that will do entity creation. So they will help you create the LLC or an S Corp or whatever makes more sense for you. They'll help you with tax strategy, tax planning, how to get all of your different write-offs, all of that stuff. And they'll do a free consultation for you. So you just have to set up a call with them. You set up a call. They'll do I think it's a 45-minute phone call. And they will literally, if you want to set up an LLC, if you want to set up a business, they'll help you structure it. And then they'll show you how to waterfall everything through those entities so that you can lessen your tax bill. Because taxes being the biggest eroder of wealth, put it this way. This year, I will, if I didn't do anything, if I just filed my taxes normally, next year, my tax bill, so what I have to write a check for to the IRS, would have been nearly $500,000. A lot of money, right? What I did is I set up a corporate structure and I set up something that's called a private family foundation. Very high level strategy, but it doesn't make sense for everybody. It cost $95,000 to set up. So if your tax bill at the end of the year is 70 grand, it doesn't make sense to set up something for 95 grand because your tax bill is 70 grand, right? My tax bill was going to be 500 grand. So would you pay $95,000 to save $500,000? Of course, because then you're still saving $405,000. So think about that. If I have $405,000 that is not going to Uncle Sam, it's staying with me, what can I do with it? I can go buy more houses. I can put more money into my infinite banking policies. I can start more companies. I can pour more money back into my companies. So guys, taxes are the biggest eroder of wealth. I urge you guys to set up a call with this company. In the description on the YouTube here, I have the link and I'll actually put it here in the comments. Hopefully you guys can see it, but I will put it, and I would highly urge you guys just to set up a consultation with them and, see if it makes sense for you to do it. It's a free consultation. They actually set up the entity for you at no cost. The only thing you have to pay for on the entity is just the filing fees. So let me know if you guys see that. I just put it in the chat. Hopefully it shows up. Perfect. All right. So guys, use that link. Set up a call with these guys. They specialize in corporate structure, how to set things up properly for your side hustle, your business, whatever you're thinking about doing. They specialize in how to set it up for the max efficiency. And then once it's set up, they'll work with you on tax planning, tax strategy. So if you're a real estate investor, they'll show you where you can get more deductions, whether it's cost segregation, whether it's bonus depreciation, whatever it may be. They will help you get all of your deductions through tax planning, tax strategy. Then they help you with estate planning, which is huge. Guys, the more successful you become, like the higher up on the flagpole you are, the bigger of a target you are, right? The higher you go, the more people can see you. Now you're a target. So the more money you make, the more successful you become, you've got to have layers of protection. And the way you do that is estate planning. through trusts. Prime example, guys. I don't own anything, nothing. Everything that I own is actually owned by my trust. So I don't own it. If you try to get something from me, good luck, because I don't own anything. I control everything. I control the trust. The trust owns everything. All my houses, all my cars, all my policies, my infinite banking policies, they're all owned by a specifically designed trust, because then it gives me layers of protection and it lessens my tax bill. So I highly recommend, guys, set up that call, see if it works for you. And again, at the end of the day, they'll set up an entity for you at no cost. If you want to start doing other things with them, there's obviously cost behind it. Tax planning, tax strategy, tax filing, all that stuff has a cost, and they'll go over that with you. But I don't want you guys to think of it as a cost. Remember, I paid $95,000 to set up my corporate structure. That's not a cost. That saved me 500 grand. So if I came to you and I said, hey, give me 95,000 bucks. In return, I'll give you 500,000 bucks. That's not a cost. That's you investing 95 grand to get 500. So you got to look at your tax planning, your tax strategy, your corporate structure, and your estate planning, all that stuff as an investment to keep more of these things that are leaking from your wealth, from your money. You got to keep more of your money, and then you got to be able to multiply it. Okay. So let's get into a little bit of that. Let's see if anyone had any questions. Let's see. The irony of the 401k trap is that people are fearful of the penalty and tax of taking the money out before 59 and a half, but don't realize that the money in there is subject to being completely lost. 100% correct. So that was Michelle. She said, people don't realize that the money, you can lose it. There's no protection against market volatility. So if you have a 401k and the market crashes, so does your money. And I think more than ever right now, guys, is a time where it's more important to preserve, to protect your money rather than to go make a lot of money, because markets are so volatile right now that if you go put your money into an investment that has some risk, you could lose money. And Warren Buffett, he says, buy low, sell high, and don't lose money. Reason why, let's say I've got $100. $100, I put it into an investment and I lose 50%. So I lose 50%. I've now got $50, right? Just to get back to having $100, I have to make 100% return just to get back to where I was at, just to get to square one. So where can you make 100% return? There's not a lot of places without a lot of risk. So losing money is what you guys should be focused on more than anything. And that is why I funnel all of my money through infinite banking policies, because these policies are guaranteed to grow. You'll never, ever lose money, ever. They are guaranteed, contractually guaranteed to never lose value. Doesn't matter what the stock market is doing. Doesn't matter what the housing market is doing, what crypto is doing. Your money is going one way, and that is up. And if you understand compound interest, it doesn't do much at first. So you got money, it's compounding, it's compounding, it's compounding. It's starting to do its thing, and then exponentially goes up the longer you have compound interest working. So if you have something that is never stopping the growth, it's always growing, and you keep feeding more to it, you're putting more of a baseline for it to grow off of. The bigger it gets, the more you can use it for more things. That's why I've been able to buy a Audi R8. That's why I've been able to do real estate deals, because I've built up a lot of money inside of these infinite banking policies. All that money is not going to ever stop growing. It's just going to keep getting bigger and bigger. So I never lose the money's ability to grow. That's why all my money flows through that. So it's protecting it. It is protected against lawsuits and judgments. So that is the biggest thing, guys. Preserve your capital. Get rid of all of the eroding factors. Taxes, huge one. So schedule that call with those guys so they can help you out there. Then once you get rid of eroding factors, so think about this. On your bills, you've got interest that goes to other people. If you have, let's say, a car loan that you owe $10,000 on, and you put money into your policy, your infinite banking policy, and you've got $10,000 now in cash value, you can use that cash value to pay off the car. Your $10,000 just keeps getting bigger and bigger. It keeps growing because you're not using it. It is collateral to borrow against the policy. So you're taking borrowed money, which is borrowing from your death benefit, to pay off the car. Now all you do is you take the money that you were paying on the car, let's say it's $500 a month, and let's say you've got however many years left, you just take that amount and you simply pay it back to your policy. What you're effectively doing, you're getting rid of the eroding factor of interest that is owed to the bank. You're paying that back to yourself. You're getting the interest now. So if your car loan was 6% interest, you're getting 6% interest now. The whole time your money is compounding and growing. The 10,000 bucks, you're feeding more to it because you're feeding it back with interest, and it grew and compounded tax-free. So you're getting rid of taxes, right? Or not getting rid of them. You're lowering the tax obligation. You're getting rid of interest to other people. So that's another place that erodes your wealth. You're getting rid of that. It's flowing back to you instead of flowing away from you. Then what you guys need to be able to do, once you get rid of all those, all that money that now is staying with you, learn how to start investing it. Learn how to start multiplying it. Prime example. Let's say, I'll give you a real example. In my policy, I had an extra $300,000 just chilling, doing nothing. It's compounding and growing, guaranteed. That's going to happen. But if I can borrow against that 300 grand and then take it and put it into an investment, let me draw it out for you guys. So all right. So in my policy, $300,000, okay? That money is compounding and growing tax-free. With dividends, it comes out to a little over 5%. Let's just say 5% to make it easy, okay? So this $300,000 is compounding and growing at 5%. Now, the way these policies are structured is I can borrow against this money to go make more. So if I borrow the money out, so $300,000, that's borrowed, meaning this $300,000 does not move from the policy. So it's still going to earn me 5%. I'm borrowing it so that way I can take it and go make more. So when you borrow from a policy, you have to pay, or I shouldn't say you have to, you're charged interest from the insurance company. Whether you pay that or not, that's up to you because they don't care if you pay it or not. Here's the thing. You're borrowing from your future death benefit. The insurance company knows you're not going to live forever. You're going to die at some point. So if you don't pay this back, if you don't pay back the interest, they're just going to deduct it from your death benefit paid to your family. So you never have to pay it. You should, but you never have to. So 300 grand is borrowed at 5%. Okay. Now get this. I take this 300 grand and I fund a real estate deal. REI, real estate investment. So I funded a deal. There was an investor that needed money to do a deal. So I funded that deal. I'm the bank on that deal. So I lent 300 grand. I'm in first lien position, meaning if they don't make payments, I get the property. It's my property. Just like if you have a mortgage and you don't pay your payments, they can take your house. Same thing. So I'm protected by a contract, by me being on a lien on the title. So that 300 grand is earning me 12% interest. Okay. So get this. Here's where it gets good. I'm earning 12% with $300,000. I'm also earning 5% with $300,000. So altogether, I'm earning 17%. I had to borrow it at 5%. So all of you mathematicians, if I'm making 17, but I got to pay 5, what's my rate of return? Someone tell me. What is my rate of return? If I'm making 17 and paying 5, what is my rate of return? Hussein said 12%. Is that what everyone thinks? 12%? Ingrid said 12%. Who else? All right, so 12% looks like what people think. So here's what you guys need to understand. Hussein said actually 17. So incorrect. If I took 300 grand, my 300 grand, and made 17% or made 12%, that's my actual return. But remember, I'm not using my money. My money is sitting in here compounding and growing. I'm using the insurance company's money. I'm borrowing 300 grand from their general account. So I make 17, but the only money I actually have working is the 5% of interest that I pay the insurance company. So what I'm doing is I'm taking 5% and turning it into 17%. So the rate of return on that is about 340%. That's my rate of return. And you guys can do that all day long. It's not hard. All you have to do is first put your money into a policy, because a policy is guaranteed to grow. So you're going to get that growth in the policy regardless if you use it or not. So if you borrow against it, all you're doing is you're controlling $300,000 from the insurance company. You're controlling that money for 5% interest. Now you just got to take it and go make as much as you can. 10%, 15, 7%, whatever the difference. So if you pay 5 and make 10, you're keeping the spread. You're keeping 5%. And then your policy is still growing at the same time. So guys, you can do exactly what I did. The way I lend money and the way I get money when I do real estate deals is from something called the Private Money Club. And all it really is it's It's like a dating site for money. That's the best way I could put it. Like think about on a dating site. So Tinder, Bumble, Match.com. What all they do is they pair people together. So you've got a guy and a girl, a girl and a girl, a guy and a guy, whatever people are into. And one is looking for another person. They see each other on the site and they pair up. They start talking. They go on dates, blah, blah, blah. That's what the private money club is. It's people that have money and then people that need money. So you've got real estate investors, people that are doing flips, people that are doing, I don't know, multifamily deals, apartment complexes, like you name it. They want to use other people's money. They don't want to use their own. They want to borrow, use other people's money, and then they pay them interest. Then you've got people that have money that just don't know how to actively invest, how to go do flips, how to go do rentals, how to go do apartment buildings. But they want to use, they don't want their money sitting in the bank, earning them nothing. So the private money club pairs those two people together. So if you have money and you're looking to invest, you can go through and search through deals and say, oh, this deal makes sense. I'll do this deal. If you have a deal, if you're an investor and you need private funds, you put your deal on the private money club. That's how I've funded all of my deals. I put the deal on the private money club and I get it funded within like a day. So people reach out, they're like, hey, I'd like to fund your deal. And then you start talking, everything goes through escrow. You've got different contracts in place. So if you guys want to do that, I would highly recommend it because you can start deploying your money. The smallest deal I think you can do is like 20 grand, 25 grand, something like that. But think about it. On this deal, I'm making a 340% cash on cash return. And you guys can do the exact same thing if your money first flows through a policy. If I didn't flow it through a policy, if I just took my 300 grand and lent it out on a deal, I'm only making 12%. Remember, that's how much the deal is making, 12% on this deal. So if I just take my money, put in the deal, I've got $300,000 in that deal, making me 12%. That's what most people do. But if you simply add the one step of putting your money in the policy first, it's making you 5%, tax-free. You borrow against it, then put it into the real estate deal. You just took your 12% return up to 340% by simply adding that one step. So I'm going to also put in the chat a link for the private money club if you guys want to check that out. It's also in the description on this video. So let me know if you guys see that. I just put it in there. Dustin says, plus it's a 5% as a tax write-off for a business expense. Exactly. Very true. So guys, when you borrow money from an infinite banking policy, you don't have to pay the interest. You can literally never pay it. It's just going to come off your death benefit. However, you should pay it. A couple reasons why. One, if you pay it from a business account, which is what I do, it is a tax write-off. It's a business expense. So let's say over the course of the year, just make math easy. Let's say I borrow $100,000 at 5%. That's a $5,000 expense for the business. So that comes off of my taxable income. I don't get taxed on that $5,000, which is great. Second, when you pay that 5% interest to the insurance company, if you're with a mutually owned company, which means as a policy holder, you are an owner of that company, kind of like a stockholder, right? The company, when they generate a profit as an owner, you get a share in those profits, which is a dividend. So the more profitable the company is, the bigger your dividend. So you paying 5% to them is helping you get a bigger dividend and helping you lower your taxable income if you're paying that money from a business account. So you never have to pay it, but you should all day long. Freddie Rivas, PMC is best resource for lenders and borrowers. I love it. Yeah, Freddie. I mean, guys, again, that's how I get all of my private funding. Any real estate deal I do, I get the funds from lenders that are on Private Money Club. And it can be anyone. It could be you, it could be your mom, your dad. Anyone can lend money. And if you do it in a way where you're protected by a contract, it's like the easiest and safest way to make money. You don't got to do anything. You just lend your money and you just get checks in the mail. So I've got all of my private money from the Private Money Club. I just started lending money on the Private Money Club because me as an active investor, nothing really makes sense right now. Like things are too overpriced, rates are too high. I'm not going to flip properties. I only do the Burr method, buy them and hold on to them. But since rates are so high, the numbers just don't pencil out. So I'm not actively investing until things start to change. So what I'm doing is I'm just putting my money into other deals. So you do that through Private Money Club. You can get your deals funded, or you can lend your own money and make money off of it. If you flow it through a policy, you're just multiplying the amount of money you make. So very simple stuff. Dustin said, will you be at Cherry Lynn Road Meetup tonight? Yes, I will be there. So any of you guys that are in the Phoenix area, I put up a story yesterday, I believe, of a meetup I'm going to be at. It's a multifamily meetup. We're going to be talking about real estate and how to become the bank on real estate deals. So I will be there. Check out the story on Instagram so you guys can see where that's at and meet up there. It's at 6:30 tonight. Fernando said, what companies do you recommend, or where can we find where to start infinite banking? So the agent is more important than the company. Reason being, the agent has to know how to structure the policy for infinite banking. If they don't know how to structure it, they're just going to structure a regular policy, which is built for the death benefit. And you can't use that for infinite banking because there's no cash value. So they have to know how to structure it. And if they know how, they have to be willing. And the reason why is because the commissions are so much less. So if they're not willing to structure it, you're just going to have a regular policy. So the agent is the most important part. I myself, I am a licensed agent. When I started doing infinite banking and telling people about it, sharing how I was using it, everyone started asking, like, how can I get one? Where do I go? What do I do? And I would just send people to the person I got mine from. And then it hit me. I was like, wait a minute. If everyone's learning from me, shouldn't I be the one that sets it up? So I got licensed, and now I'm on the same team with the people that I set mine up with. So if you guys want to, set up a policy or even just talk about it, I'm going to put another link in here. It's a link to register for a free training video. You got to watch this training video before you and I will even get on a phone call. You have to watch it. Otherwise, the call will just be inefficient with our time, really. So register for the training video, watch it till the end, and then there's a green button at the bottom where you can schedule a call, and then either myself or someone on my team will answer all of your other questions, and then we can help structure the policy so that you have it set up and you can start using infinite banking. Let's see. What makes PMC more competitive than general banks in terms of lending? Does this mean someone is borrowing from you at 12%? So Josh, yes, you create you're in control basically. So if you have $100,000 that you want to deploy, that you want to lend out, so you can look through all of the deals in the private money club. If you don't want to make less than 12%, don't fund a deal that is going to pay you less than 12%. So the the borrowers, the real estate investors, the people that have the deals that need funding, they'll put on the deal exactly what it is. Here's the address, here's the equity, here's the time frame we think we're going to need, here's what we're doing, here's the interest that we're going to pay. So you can then do the math and say, all right, I've got 100 grand, it's going to make me 12%. That's going to be, what's that, 10,000 a month or 10,000 a year or 12,000 a year, something like that. Regardless, is you're actually going to be able to determine how much you make. If no one's going to pay more than 12% and you want to make more than that, don't fund any deals. Again, guys, right now, it's more important to conserve your money, to not lose it, rather than go make a huge return. So if you can make a 12% return, that's good. That's what I'm making on these real estate deals. Plus in my policy, I'm making 5 and I'm borrowing it at 5. So I'm technically making a 340% return. As far as banks go, it's better than a bank because when you have private money, there's no qualifying. So like if I needed to raise capital, if I wanted to go to a bank, I got to give them my social. They got to run my credit. I've got to give them financials. It's going to go through underwriting. It's going to take forever. And in real estate, time is your enemy. You want to get things done right now. So with private money, there's none of that. You don't run someone's credit. You don't run their financials. You base it off of the asset. So if I'm a lender lending my money, I'm going to look at that asset. If I look at the asset and I see everything around it is selling for $1 million and the investor is buying it at 500 grand and it only needs 100 grand worth of renovations, that means at most it's going to be 600 grand in the deal, but it's worth $1 million. That's not a risky deal at all. I'll lend money on that all day long. Because if the market drops, let's say 20%, the house is now worth 800 grand, but it's still only 600 grand in it. There's still 200 grand of equity. So private lenders and hard money lenders, they do not base things off of the individual. They base it off of the asset. Hopefully that makes sense. So that's the difference between banks and private lenders. Devin, is there anyone you know in East or on the East Coast, specifically Jersey, that's doing a meetup like what you just said in Phoenix? Yes, actually, I've got a great friend of mine. He actually is from Jersey. He does most of his business in Jersey. He's started to do a lot of business out here in Phoenix, but most of it all started in Jersey. He still does a ton in Jersey. And he's got a partner that still lives in Jersey. So they do meetups and stuff all the time out there. His name is Ricky Morgan. Look him up on social media. He's got a YouTube. It's called The Flip Lab, FLIPLAB, Flip Lab. And you can look him up on social media, on Instagram and all that. So reach out to Ricky. Let him know that I sent you over. And just ask when they're going to have a meetup out there in Jersey and just stop in. LC, why don't you do a 90-10 design for a policy? Great question. So guys, the way policies are structured, is based on a couple of different factors. So when you have a policy built for regular, like a regular whole life insurance policy, it's made up of what's called a base premium. So that's base premium. that pays for the death benefit. Okay. So the bigger your base premium, the bigger your death benefit. However, base premium does not build any cash value for several years, 10, 11, 12 years sometimes. So if you have a regular policy, if it's all base premium, there's not a lot of cash value. What gives you cash value is when you take base premium and put a small amount, and then you put paid up additions on top. So PUAs. This gives you cash value. So base premium pays for the death benefit. Paid up additions, PUAs, accelerates the cash value early on. So you can do 10% to the base premium, 90% to the paid up additions. That's the most aggressive you can do. If you do more than that, it's going to become what's called a modified endowment contract, which means it's going to become taxable. You don't want it to be taxable. So the reason I do not like a 90-10 or a 10-90 is because you can only do paid up additions for so long. Generally, the way we structure policies, it's for 7 years. So we jam as much paid up additions into the first 7 years. That way, all of that extra money is going to grow for the rest of your life. So once you get to the point where you can't put any more paid up additions in, because if you do, it becomes taxable, this falls off and all you can put in is 10%. So think about it. In 7 years, once the compound interest is really starting to do its thing, because compound interest takes time, you're limited on how much you can put in. So if your policy is $10,000 a year and 10% is your base, so $1,000, after 7 years, your compound interest is starting to really get cranking. You can only put in $1,000. You're going to slow everything down. So think of it this way. The base premium is what accelerates the cash value in the later years. The paid up additions is what accelerates the cash value in the early years. So I don't like a 1090 for that one reason, is that after your paid up additions fall off, you're limiting your growth. I like policies that give a lot of cash value up front, but they don't limit the growth in the later years. So I tend to do my policies, the most aggressive I'll do is 25% to base. These are my personal policies. 25% to the base, 75% to the paid up additions. So I'm still getting a lot of cash value up front, but in the later years, I'm able to put more in so that it keeps growing like crazy. Another reason that I don't like it is if you do a 1090, what you have to do 9 times out of 10 to make sure that the policy does not become taxable is you have to do a term rider, which is term insurance. You have to put that on there for the first 7 years to boost the death benefit so that you're not becoming taxable. When you do that, you're giving yourself more life insurance, like more death benefit. If you do that, you're limiting your ability to get more policies. So if you start using one policy and you've maxed it out and you want to try to get another, you might not qualify because the insurance company might say, you've already got enough death benefit. You're overinsured. So now you're kind of shooting yourself in the foot. I do not think a 1090 is the way to go. 2575 is really the most aggressive I'll personally do on myself. I've got ones that are 40, 60, and even 50, 50. So hopefully that answers it. I went into kind of a lot of detail, but that is why I do not like the 90-10 design. How should we have to start this policy? Not sure what you mean, Pedro. How much should you have? As much as possible, as much as you have. The more you put in, the more you can use. The more you put in, the more it grows. So more the merrier. I got student debt to eliminate, but want to leverage the initial dump into the policy for IBC to start investing into real estate. Which do you tackle first? Can you do both simultaneously with how you move money? Michelle, great question. I look at it like this. If you have a debt, you said it's for student loans. So it depends on what the interest rate is. If your interest rate on your debt is less than the amount of money you can make by investing, don't pay it off. Go invest the money, make a return, use that return to pay down the debt. So you're getting the best of both worlds. If you just take the money from a policy and start paying down debts, it's good, but it's not great. I would take the money if you can make more than what the debt service is. So if your interest rate is 20% and you can't make more than 20%, get those debts paid off, recapture the money, then invest. But if your debts are 5%, 6%, and you can take money and put it into private money club, for instance, and make 12%, do that, because then you're making more money than what you'd be paying down. Take that made money and pay down the debt. That's what I would do. Hopefully that answers your question there. You've been my doorway to this information, Hussein. Appreciate you. All right, so that looks to be all the questions. All right, guys. I actually have a call. I have to jump on in 11 minutes. So hope you guys got a ton of value from this. This is actually going to be recorded. I'm going to put it on my my YouTube. So if you guys need to come back and refer to it, in the description, you're going to have the link for the corporate structure, setting up that free consultation like I was telling you guys. You're going to have a link to the private money club so you guys can check that out. I would highly recommend setting it up so you can start lending your money and making money, or funding your real estate deals, funding whatever you need funding. And then also there is a link to register for my training video. It's an hour long. You got to watch the whole thing. At the bottom, you'll then see a green button to schedule a call with my team. So appreciate you guys. Thank you so much for joining. You guys on Instagram, I didn't answer your questions and I apologize, but I had to turn the camera around so you guys could see everything, not written backwards. So thank you guys. Appreciate you guys. Till next time. Peace.